Are you considering a home equity line of credit or a HELOC as an alternative way to access equity in your home? In today's video, I'll compare and contrast the home equity conversion mortgage and the home equity line of credit to help you make an informed decision about your financial future. And remember, always check with your family and a licensed financial professional before you make this or any other major financial decision. Now sit back and get ready to learn the truth about reverse. If this is your first time here, please like this video, subscribe to my channel, and be sure to tap that bell for notifications so that you can keep learning right along with us. And if you do have questions or want some specific information about reverse mortgages, I am more than happy to help. My contact information is in the description right below. Feel free to reach out to me anytime. Those over age 62 have amassed more than $13 trillion in home equity, and it largely sits idle during retirement. My name is Brian McCray, and I'm here to change that mindset. Although reverse mortgages aren't for everyone, in the right circumstance, they can be an extraordinarily powerful financial tool that will help you thrive in retirement. The home equity conversion mortgage isn't the only way that you can access equity within your home. And I get questions a lot about the home equity line of credit and the viability of that as an instrument as well. And my typical guidance is if you are planning on staying in the home long term, the home equity conversion mortgage is probably the better vehicle because it actually is designed, it has features that play out the longer you stay in the home. The home equity line of credit is a great vehicle for short-term access to debt. And so if you're, say, about to sell your house and you need to remodel in order to do so, you might use a home equity line of credit for the funds to actually do the remodel and then pay the line of credit off whenever you sell the home. And that's usually the first question or the first topic of conversation among my clients is the understanding of how long they plan to be in the home. And if they do plan to stay in the home long-term, the viability of aging in place or the viability of that long-term strategy. And if they are planning on staying in the home for, say, more than 24 months, the home equity conversion mortgage might be a great fit in that case. But in any less amount of time, a home equity line of credit or some other alternative might be a better fit in that case. Now, there are some fundamental differences between the two instruments that will help you determine their overall fit. One of them is permanence. One of the reasons why we look at the home equity conversion mortgage as being beneficial over time is because the line of credit is permanent. It can't be canceled. The home equity line of credit, the HELOC, that line of credit is designed to be temporary. So usually you have access to the line of credit for a set amount of time. And so that permanence is a big factor in determining which instrument might be a better fit for you. The other factor is payments. One of the biggest advantages of the home equity conversion mortgage is the fact that principal and interest payments are not required. And so if you are on a fixed income in retirement, managing that monthly cash flow might be the most important thing. Where the home equity line of credit typically has a monthly payment associated. In some cases, it's going to be interest only, but you still have to factor that monthly payment into the overall cash flow equation. These are the primary differences between the two instruments, the permanence factor of the line of credit and also the payment. Now, there are some other differences between the two instruments that may be a little more subtle, but we're going to get into those now to help you understand them at a little more depth. One of the most powerful features of the home equity conversion mortgage is the line of credit growth. And so if you are bringing in that paid off home or you have that small loan balance where you're going to have an extensive line of credit available, that growth feature can play a big role in strategic planning and understanding how much wealth you're going to be able to project over time. The home equity line of credit does not have any growth feature associated with it. Again, better designed for short-term access to debt, and so it doesn't have that capability for long-term growth. Now, there are many protections that are built into the home equity conversion mortgage. Remember, it was built from the ground up to serve those that are near or in retirement. And one of those biggest protections is from negative equity. The non-recourse feature of the home equity conversion mortgage ensures that no matter what the home is worth, only the value of that home can be used to cover the loan balance. And if we get into a situation where the loan balance might exceed what the home is worth, that outcome is guaranteed. So effectively, the home equity conversion mortgage protects you completely from a negative amortization situation. You do not have those protections in place with the home equity line of credit. So those are the biggest differences between the home equity line of credit and the home equity conversion mortgage. We talked about the payment requirement. With the home equity line of credit, you do have a monthly payment requirement. With the home equity conversion mortgage, there is no principal and interest payment requirement. We talked about the timing. The home equity conversion mortgage, that line of credit is designed to be permanent. It's designed to be able to be utilized in a guaranteed fashion for as long as you stay in the home. The home equity line of credit typically does have a time associated with it, so you're only able to access that line of credit for a set amount of time. Then we talked about the liquidity growth feature of the home equity conversion mortgage as a way to actually help you project and grow wealth. The home equity line of credit, because it's more of a temporary vehicle, doesn't have that available. And then finally, we talked about that negative equity protection, the no recourse feature that the home equity conversion mortgage has that the home equity line of credit doesn't. So as you can see, the home equity conversion mortgage was built from the ground up for this audience to help you age in place effectively. And there are all sorts of controls and protections and insurance in place to help you over the long run. Now, the downside is the home equity conversion mortgage is more expensive to close. And so if you need short-term access to debt, if you're only going to be in your house for, say, less than 2 years, the home equity line of credit might be a better fit. Even if it has that payment requirement, it might carry a little bit more risk because the closing costs are typically less. And so understanding your situation, understanding your needs is really important part of understanding which of these instruments might be a better fit. So as you can see, a big part of the conversation is understanding how long you're going to be in the home, as well as your needs for equity. Remember, the answer isn't always reverse mortgage. What's important is that we secure you in your forever home and put that home equity to work for you in the best possible way given your retirement. I hope this information was helpful. Until next time, keep on learning the truth about reverse.